6.5, 6.5%. That is the gap right now between what you can buy silver for New York and what buyers in Shanghai are paying for the exact same metal, $5.41 per ounce. Not in a report, not in a forecast. Right now, today, as you are watching this. And if that number does not make you sit up a little straighter, stay with me, because by the time we are done here, you're going to understand exactly why that gap exists, exactly what it is telling us about the structure of the silver market, and exactly what you should be watching for over the next 7 days. Before we get into it, last week I told you to watch COMEX registered inventory figures. I said if we saw continued drawdowns alongside elevated open interest, that would be the early warning sign of structural stress in the paper market. Here's what happened. Registered stocks came in at approximately 100 million ounces. Open interest landed at 112,794 contracts. At 5,000 ounces per contract, that means the paper market has written promises on roughly 564 million ounces of silver, while the registered vault holds 100 million. That call was directionally correct. The stress signal has not faded. It has gotten louder. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here. This channel has no sponsors. It does not sell you anything. And everything I show you today comes from publicly available sources. I will name every single one as we go. Here is what we are covering, why the Shanghai premium is the most important number in the silver market right now, what the COMEX vault math actually means for anyone holding paper contracts, and what the 3 lanes framework is telling me this week about where this could go next. If this kind of calm, data first breakdown is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, this is the week to do it, because what is happening in silver right now is not a one video story. It is developing in real time, and we are going to track every step. Let me give you the market context. Silver is sitting at $82.84 on COMEX. If you are holding physical silver, you know that number well. You have watched it push and pull in that range. But here is what the COMEX price tag does not show you. On the Shanghai Gold Exchange, silver for physical delivery is currently trading at $88.25. I want you to sit with that number for a moment. $88.25. That is a 6.53% premium over the Western paper price. In commodity markets, a spread of that size between 2 major exchanges is not background noise. It is a signal. It is the market telling you that someone or a lot of someone's needs physical metal badly enough to pay significantly more for it than the headline price suggests it should cost. And before we go any further, I want to ask you something. Drop it in the comments right now. Are you seeing elevated premiums at your local dealer this week? Or have spot to retail spreads started to normalize where you are? The US and UK viewers here give me a real-time read on the ground, and I genuinely read every response. Now here's what that premium actually means, and I want to be precise here, because this is where a lot of commentary gets it wrong. A 6.53% gap between Shanghai physical and COMEX paper functions like a magnet. Arbitrageurs, traders, whose entire job is to exploit price differences across markets, will buy silver in the West where it is cheap and arrange delivery in the East where it is expensive. That arbitrage trade pulls Western prices upward. It also pulls physical metal eastward. And when physical metal moves east, it comes out of Western vaults. Think of it like 2 supermarkets on the same street selling identical bottled water, one at $1, one at $1.65. What happens? People buy from the cheap store and sell to the expensive one until the prices converge. Silver is doing exactly that right now. The convergence mechanism is a physical drain. The LBMA in London and COMEX in New York are the cheap stores in that analogy. Shanghai is the expensive one, and the water is moving east. Now let's talk about the vault math, because this is the part that stopped me. When I pulled up the CME warehouse report, COMEX registered stocks currently sit at approximately 100 million ounces. That is the metal officially available for delivery against futures contracts. Open interest, according to the most recent CFTC data, sits at 112,794 contracts. Multiply that by 5,000 ounces per contract, and you get roughly 564 million ounces worth of paper promises sitting on top of 100 million ounces of registered physical silver. Now, here is the important caveat, and I'm going to give you both sides of this honestly. Not every contract holder wants delivery. The vast majority of futures participants are traders, not buyers of physical metal. Most contracts roll or close before first notice day. This is normal. This is how futures markets are designed to work. Open interest is like counting every person in a sports stadium and panicking because a concession stand only has limited hot dogs. Not everyone in that stadium is trying to buy a hot dog at the same time. A lot of them will leave before the final whistle. So the raw ratio alone is not a countdown timer. But, and this is the but I want you to hold on to, that calculus changes when physical demand from outside the futures market starts applying simultaneous pressure. When Shanghai is paying 6.5% more for physical delivery at the exact same moment that COMEX registered stocks are sitting at 100 million ounces, the margin of safety in that system gets thinner. It does not take every contract holder demanding delivery to create a problem. It only takes a meaningful minority, and that minority becomes more likely to appear precisely when the arbitrage incentive is this visible and this large. The CFTC flagged in their most recent commitment to traders report that manage money net long positions. The hedge funds, the professional speculators, have been running at a historically low level. When I pulled that number up, it genuinely surprised me. What that tells us is that the current price action is not being driven by a crowded speculative long position. There is not a bubble of leveraged paper longs waiting to unwind. The buying pressure that exists in this market right now has a harder floor under it. If you know someone who has been watching silver this week and trying to make sense of these moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Now, let me add a layer that most Western commentary is not spending enough time on. The Shanghai premium does not exist in a vacuum. It is connected to a broader set of structural changes in how Eastern markets, particularly China, are positioning in physical commodities. The Shanghai Gold Exchange is not a fringe venue. It is the largest physical gold and silver exchange in the world by volume, when it is consistently pricing physical silver 6.5% above COMEX. That is an institutional signal, not a retail quirk. The World Gold Council has documented in recent published data that central bank gold accumulation, particularly from emerging market central banks, has been running at elevated levels. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into hard assets, that is a multi-year, strategic decision. The direction of that travel is documented and visible. And for UK viewers specifically, the LBMA Vault data, which is published monthly and tracks physical silver holdings in London, is worth checking right now. Any meaningful reduction in LBMA Vault tonnage alongside the Shanghai premium would confirm that the eastward drain is not just a COMEX story. It is a global one. The dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible, and the Shanghai premium is one of its live symptoms. Now, here is something that rarely gets discussed when people talk about the silver price, and I want to walk you through it because it is directly relevant to why physical demand is so sticky right now. Silver is not like oil where you can watch it burning. It is hidden inside electronics, solar panels, medical devices, EV connectors. It is everywhere, and it is rarely recycled perfectly because it is dispersed in tiny amounts across massive industries. The Silver Institute, which publishes the most comprehensive annual supply and demand figures available, has documented a structural supply deficit in silver for multiple consecutive years now. Demand from solar panel manufacturing alone has been growing at a rate the mining industry has not kept pace with. I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the data shows is the direction of demand, and that direction has not reversed. For UK viewers, the North Sea energy transition and the UK government's solar rollout targets are adding incremental physical demand from this side of the Atlantic as well. It is a smaller number than China's solar build-out, but is additive. Every panel adds to the same industrial floor. A deficit is not a countdown timer. It is more like gravity. Gravity does not tell you the exact day something falls. It tells you the direction of the pressure, and if that pressure builds for multiple consecutive years, the system becomes more sensitive to shocks. Right now, we have a live arbitrage signal, a vault math that leaves limited margin for error, persistent industrial demand, and a geopolitical backdrop pushing Eastern buyers toward physical accumulation. Those are not separate stories. They are the same story told from 4 different angles. All right. Let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market. COMEX open interest at 112,794 contract against 100 million ounces of registered silver. The CFTC's most recent COT report shows managed money net longs at historically low levels. That means speculative. Positioning is not stretched to the upside, which cuts both ways. There is less crowded long risk of sudden unwind, but also means any shift in sentiment from neutral to bullish has room to run. Paper market this week. Structurally, stressed but not yet at breaking point. Watch the registered inventory number closely on every CME warehouse report. Lane 2 is the physical market. The Shanghai Gold Exchange pricing silver at $88.25 against COMEX at $82.84 is a headline, but the LBMA vault data and Royal Mint sales figures in the UK are the confirming data points to watch. If UK Royal Mint silver sales are running above seasonal average, while LBMA vault tonnage is declining, the drain is not just a paper-to-physical story in the U.S., it is transatlantic. Physical lane this week. Elevated premium directional, drain in progress, arbitrage incentive active. Lane 3 is macro. The dollar index, the DXY, is the single most important external variable for silver right now. If the DXY pushes above 100, that historically applies downward pressure on dollar-denominated commodities, including silver. The Federal Reserve's most recent communications have kept rate expectations uncertain enough that the dollar has not made a decisive move in either direction. The CBO's published fiscal projections, which show sustained multi-trillion-dollar deficits as far as the forecast window goes, continue to apply long-term structural pressure on dollar confidence. Macro, lane this week. Uncertain short-term, structurally dollar-negative medium-term. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. The paper lane still has structural shock absorbers, but the physical lane and the macro lane are both pointing in the same direction, and the paper lane is under more stress than it has been in months. That is a framework, not a forecast. You decide what to do with it. Now, if you've stayed with me this far, what I am about to give you is the specific, single thing I am personally watching this week. Not three things. Not a list. One thing. Here is the one thing I am personally watching this week. I am watching the $85 level on silver in the U.S. market. Specifically, I want to see how COMEX futures behave if spot silver tests $85 during regular trading hours on a day. When CME warehouse registered inventory data is simultaneously published, the reason $85 matters is this. The article analysis I pulled this week identifies $85 as a likely trigger point for a catch-up move toward the Shanghai price. If paper market buyers step in at $85 and push through it with volume, that tells us the arbitrage signal is transmitting into Western price action. If $85 is rejected, particularly if the DXY is simultaneously breaking upward toward 100, that tells us the macro headwind is strong enough to override the physical signal. For now, the data source to watch is the CME warehouse report published each business day, combined with the COMEX settlement price. Both are publicly available. I want to see them move together. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop, and here is what needs to happen for the cautious picture instead. For the optimistic case, silver needs to break and hold above $85 on COMEX, with real volume behind it. If that happens while the Shanghai premium remains at or above 5%, the arbitrage incentive stays active and Western prices have a credible mechanical pull toward $88 to $92. The structural backdrop, low, speculative longs, persistent physical deficit, Eastern institutional demand, gives that move legs beyond a short-term squeeze. That is the genuine bull case, and it is supported by real data. For the cautious case, the DXY breaking above 100 would apply meaningful downward pressure on silver regardless of the Shanghai premium. Arbitrage trades work, but they work on a timeline, and if macro headwinds accelerate, silver could retest the $78 level before physical buyers at those prices step in as a floor. There's also the possibility that the Shanghai premium narrows not because Western prices rise, but because Eastern demand softens. And if that happens, the magnet loses its pull. Both outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers. First, are you currently holding physical silver, mining stocks, or both? And has today's video changed how you are thinking about the ratio between them? Second, when you look at the $5.41 Shanghai premium, do you read that primarily as a supply signal, a demand signal, or a currency signal? Drop both answers below. Next week, we are going into how to read the CFTC commitments of traders report line by line, not the headline number, the actual breakdown, and I will show you exactly how to extract the signal from the noise. That is a skill worth having. Subscribe so you do not miss it. And if someone in your life is watching their stack right, now and feeling confused about what is happening. Share this with them. That is the whole point of this channel. This is Currency Insider. Know the market.